All right. Well, thank you everyone for participating in our first webinar for 2025. Wanted to take the time to kind of go over the cash balance retirement plans and how for companies that have pretty good cash flow and tend to be profitable, how doing a cash balanced retirement plan can really help benefit both the entity from potentially reducing their tax liability and then also helping owners or shareholders or partners within an organization really begin affecting how much the retirement compensation is for the future. So to help kind of go through that presentation, I've got Ashley Gregg with Associated Pension Consultants. I kind of walking through kind of the pros and cons of how the cash balance retirement plan works, some of the different retirement contributions to consider, the methodology, and also some of the Department of Labor, ERISA, with some of the requirements they have about that one. So I believe we probably have a way that guys can maybe chat. I'll try to monitor the chat just so we have any comments coming through from people. But Ashley, if you just want to go forward, we've got a PowerPoint set up to go
Yeah,
through that one and just kind of ping me when we need to change slides or just do like an overview of kind of what we plan to cover for maybe about 30 minutes and then leaving about 10 minutes or so for any follow-up questions that the group may have.
yeah, that sounds perfect. Thank you, Evelyn. Thank you for inviting me to speak today. Defined benefit plans in a nutshell is essentially what we're going to be discussing, but I'm going to go over how the plans work, what the requirements are, and if there's any questions. I know that defined benefit plans can get kind of muddy, if you will, but I think if we're looking at defined benefit plans, and Evelyn, go ahead and go to the next slide. uh, when we're looking at defined benefit plans, we're looking at an employer or an individual that owns a company that wants to make a large tax deduction that's larger than that $69,000 limit for 2025 or going forward. So usually when we're talking to employers and they want to make 100,000, 200,000, $300,000 contributions into a plan, we would start looking at defined benefit plans for that individual, and based on if they have employees or not, that's going to affect how much they have to contribute to the plan and what direction we're going to go with the formulas in that way. The nice thing about defined benefit plans or cash balance plans, they are used interchangeably, the wording. But the nice thing about defined benefit plans is that you can make these larger tax deductions. They help with the rapid wealth accumulation. um, but some of the things that we need to be conscientious of as we're setting these plans up is that there are required contributions. The IRS likes to see these required contributions be made for at least 5 years. And usually we like to set these plans up on a 5 to 10 year term. There is going to be a guaranteed benefit to the participants, and it's going to be based on their accrued levels. So how long have they worked with the company? How many years have they been with the company at 1,000 hours? And then based on that information and how much is being put into the plan, we come up with a formula with our actuaries on what goes to the participants. Next slide. Okay, so if we're looking at defined benefit plans and we're comparing them to 401k defined contribution plans, this is just a slide that gives you kind of a basic difference between the plans. You can see here with defined benefit plans that you're working towards an accrued level. And I have a spreadsheet that I'll show in just a second, but we're working towards an accrued a level. So basically, if you look at defined benefit plans as currently the maximum limit that you can get out of a defined benefit plan is about $3.1 million as an individual owner. So we would want to look at that like a mortgage payment. Your mortgage is $3.1 million. You're going to have 10 years to pay it off. And based on your compensation, your mortgage payment will be 3.1 divided by 10 years. And that's kind of how you come up with your defined benefit contribution. So, for example, Evelyn, can you show that spreadsheet? Here we go. So this is a good example of your lump sum at retirement. If we're looking at that column that says $3.3 million, well, over the course of 10, 15, or 20 years, depending on how long you want to run this defined benefit plan, this would be your average payment into the plan to get you to that $3.3 million payout at the end of the life of the plan. Same thing, we have a $2 million accrual limit and then a $1 million. So if you're looking to have $1 million in the course of 10 years, your compensation is $260,000 plus, then you would be putting in about $130,000 over the course of 10 years. We'll talk more about the formula and how that works with applied earnings, but this is a simple way to break it down. If you look at defined benefit plans like you're backing into a mortgage payment, you are eventually going to be paying yourself this accrued limit of 1, 2, or $3.3 million is the maximum you can take out of a plan currently.
Actually, are these amounts going to be what someone's salary is going to be, or what the retirement contribution to the retirement plan would be?
This is going to be what the retirement contribution to the defined benefit plan would be. And we base this, I mean, this is going to be if we had the perfect employee or employer at this time. So we're looking at someone that's age 52,
Mhm.
someone that makes high earnings and compensation. We're talking about $280,000 annually, and has 10 years to retire, so age 52 to 62. Obviously, if you shorten the lifetime of the plan to 5 years, then you would just want to double that 10-year payment. Um, but it is possible to make these larger contributions into a plan to get yourself to that individual limit. And then, of course, if we have employers that maybe don't make that much, don't make as high as $280,000, they make less than that, but they still want to make large payments into the plan. That's a scenario that we would definitely look at and run some scenarios so that the employer and the advisors and the CPAs can all take a look at here's what your contribution is going to be. But this example here would be your ideal candidate, age 52, high earner, is going to run the plan for at least 10 years. And this is what they're working towards that $3.3 million or something similar.
Okay. Okay.
hmm Okay, so we can go back to the slide. Okay, so again, when we're looking at the difference, you have that defined benefit plan. It is a promised benefit. You're working towards that accrued limit of 3.3 or whatever is decided when we write the formula. We use an average compensation. So when you provide compensation amounts to us as a TPA and we run those formulas, your average compensation is going to be used over the course of a 3-year term. And again, the higher the compensation is up to the maximum that we can look at, the better it will be for those larger contributions that you're looking to put into a plan. Um, when we're when we're
I'm sorry.
comparing it,
What's the difference between investments, a pooled trust versus a pooled or directed trust? Pooled.
yes. So when you're looking at a 401k plan, you are able to use your custodians that have segregated FBOs or daily valued accounts, such as your John Hancocks or your American Funds, Empowers. Um, those are going to be your daily valuations or participant directed accounts. A pooled trust is where all of the funds that you're putting into the plan go into one bucket of money. They can be managed at an American Funds or something similar. Usually you see them at like a Schwab or a Morgan Stanley or some of those more pooled custodians. But with the defined benefit plan, everything's going to go into the same bucket of money, and then your TPA is going to keep track of the individual accrued balances as funds go into the plan. So just remember, as you're working towards that lifetime limit, the longer you work, the closer you are to the setup of the lifetime of the plan, the more that you've accrued throughout the life of the plan. And there's some more slides that will kind of explain that a little bit better. Where just because you put in $400,000 for 2025, you get that tax deduction, but you may not have accrued $425,000 to be taken out of the plan yet. So you have to accrue those contributions as we go forward because you're working towards accruing the full lifetime limit of the plan. So you can't just put one contribution in and then think we can end the plan. So everything goes into the same bucket. That's called a pooled trust. And then earnings are applied on an annual basis, or earnings are applied as we work on things annually. Usually with the defined benefit plan, as we're looking at formulas, we expect the defined benefit plan to earn about 5% in earnings on an annual basis. And that gets factored into how your accounts grow. Which means that brings us to our next point of the asset performance. The asset performance will affect the contributions. Whereas in your 401k plans, your participants get to decide how much they want to participate each month or pay period, etc.
Mhm.
With your asset performance in the defined benefit plans, if the earnings are above 5%, and they're 20 or 25%, then that's going to lower down that required contribution amount that you have to put in each year. Same thing on the other side is if the market has a tremendous loss, it may mean that you have to put in a higher contribution limit than expected to make up for the loss in the market.
Okay, because again, the difference is on the cash or defined benefit, there's a promised benefit there. So you always kind of have to backfill to kind of make sure that promised benefit is on track then, correct?
That is correct, 100% correct. So, there's no set limit with the contribution limits as far as you're not going to hit that. We're up to $69,000 now, but you're not going to have to worry about that $69,000 limit. Salary deferrals are at 23,500 now, so you can definitely do more than your $69,000 total into a defined benefit plan. And the benefit limits are going to be 100% of your compensation. And that says 225. That was from a few years ago. The actual benefit limit now is up to 280,000.
So
So
potentially someone could put away $280,000 into their retirement plan.
yeah, actually you could put away more than that, but the benefit limit uh yes, that's correct. So you're looking at $280,000 or more, up to 100% of your compensation. So for example, I have worked with clients that maybe they make $100,000 a year and they don't need that income. Maybe they have income coming in from other places, but in a particular company they make $100,000. Well, they want to put 100% of that into a plan. They're able to put that into a defined benefit plan, and then they're working towards that accrued limit. And at $100,000 comp, if you go back to the spreadsheet, $100,000 comp, there's another flyer that will be available here soon. But at $100,000 comp, you're going to probably be looking at doing somewhere between that, a 95 to $102,000 deduction. And that'll get you potentially to $1 million over the course of 10 years or more. Okay. So, and again, these are required contributions. So if you're unable to fund the required amount the minimum amount that needs to go into the plan to keep the plan on track to meet that high limit that you're trying to take out at the end of the lifetime. If you're unable to put that minimum in, there are tax penalties on it. So this is a big commitment. You want to be comfortable with being able to put these large amounts into the plan for at least 5 years. And even more if you're under age 50 or 52. Um, just knowing that you're going to be able to retire with potentially, $3 million in the plan or so.
Yeah. Okay.
Okay, next slide. Okay, so who's the ideal candidate for a defined benefit plan? Well, the perfect age, like I've mentioned, is age 52, but anyone that's age 40 and up could make a good candidate for a defined benefit plan. Um, if you're at age 40 and you're looking to do a defined benefit plan and you have multiple employees, the age of your employees is going to affect how much you need to give them. If you're an individual and you don't have employees, um, then obviously we don't have to worry about testing. We could take a look at it. I'm age 40. I'm going to run this plan for 20 years. And again, if we're looking at trying to get to that $3.3 million, at a 20-year term, you would just refer to that spreadsheet where, okay, my average compensation is X dollar amount, and I plan on putting two or $300,000 in per year.
Mhm.
Um, and then as you get closer to the lifetime of the plan, or we start to hit that 415 limit for individuals, we would start backing down how much you have to put in as a required minimum to get to that lifetime maximum.
Okay.
Um,
Yeah, I know there's a part at some point where I've had clients who for like freeze the plan for a number of years. I did. I think they just were we just could do the minimum, but there was always they could unfreeze it and then begin funding it at a greater rate or something. It seemed.
yeah, there's a few reasons as to why you would want to freeze a plan. You are correct. Maybe something happens cash flow wise and the client feels like they're not going to be able to meet that minimum required. Let's say that the average that's being put in is about $200,000 a year, and cash flow wise, maybe they're only going to be able to put 50 in or something along those lines. Before the end of the current plan year, if you freeze the plan, it will significantly lower the required minimum amount, which then negates any tax penalties. Other things that affect defined benefit plans that we take a look at, I hate to use COVID as an example, but when COVID happened and everybody was sent home and all of a sudden the stock market dropped significantly, and we weren't sure how that was going to end up. Some of our defined benefit clients decided to freeze their plan because we weren't sure if we were going to have to make up a large contribution for the fact that the stock market had essentially fallen, 30% in
Sure.
1 or 2 days. By
Yep.
the end of that year, obviously the stock market came back. We were able to unfreeze the plans and continue as normal. But a loss in the stock market is going to affect your contribution amount because you have to make up for that loss. Interest rates also affect that contribution amount because everything's done on an interest calculated basis, right? We're taking your current age, we're projecting your benefit out until retirement, and trying to get to that 2.8, $3.3 million. Obviously, if there's the interest rates change with how much you're putting into the plan, that's going to affect how much your contribution is going to be or what's needed to make up for those lost interest rates as well.
Okay.
Um, so most of our defined benefits plans are going to be very consistent. Once the formula is set, your average compensation or your average contribution amount will be that $200,000, that $300,000, whichever you're comfortable with. So a firm like Associated Pension Consultants is going to work with the client to make sure that they're comfortable with the contribution that is going into the plan, knowing that the contribution they're putting into the plan is what, at the end of that life of the plan, they're working towards an accrued limit. So again, the ideal candidate, age 52, high earner, making $280,000 or more. But if you're making less than that, that's okay. We just set up a formula that's less than that 2.8 or $3.3 million. But you could still potentially get 1.5, 1.7, $1.8 million over the course of 5 to 10 years. So we're just looking at ideally if you were 52, going to open a plan for 10 years, make $280,000 or more, and you want to put 300 or so $1,000 into a plan, it could get you to that $3.3 million that we saw on that spreadsheet earlier. Really, you want to look at this again like a mortgage payment, and we're backing into that mortgage. If you have a $3.3 million mortgage, what does that look like if we're making payments for 10, 15, or 20 years?
Okay. Perfect.
hmm The younger your employee is, like if you have employees in the plan, obviously we write the plan so that they have to be with the company for a year and work 1,000 hours before they're eligible. They'd have to be over age 21. Um, the younger your employees are compared to the owner, that works out better for the owner because the older the employee is, we have to also give them a benefit that's going to get them to retirement. It's not going to be as much as your owner, but it could be significant. So the younger the employees, the better, or no employees. So if it's an owner only plan, these work out great. And then again, you need to be willing to commit to at least a 5-year plan. And these defined benefit plans can be rather costly to run, but in the end, the cost really does make up for the fact that you're going to be able to save so much for retirement.
Definitely. Yep. Yeah.
So go ahead and we can go to the next slide. Perfect. This is a good example of what your annual compensation is, and based on age, how much you can put into the plan. Um, this is for 2025. We were able to get these limits, the 3.3 million of tax deferred retirement assessment for a one person contribution. So if we're looking at consecutive years of net compensation of $265,000 or higher, you've had 10 years of service in your business and 10 years of plan participation, this would be the funding tax deduction contributions, a good estimate of what you could get. I did send over a PDF, Evelyn, that says it's like max CTBS. There's a PDF that you received.
Okay.
That one is very similar to this sheet here, but it gives us a little bit more in compensation amounts, and it kind of it's a little bit bigger to see if you're able to share that.
Okay. I'll take a look at it. So the annual compensation is like say 150. Oops. Hold on. Go backwards. Yeah.
There we go. We'll just click through it again.
Yeah, yeah.
Perfect.
Um, so if annual contribution is 150, what is this at age 80, 60? What is this 150 representing? Is that how much you're going to be drawing from the retirement plan?
This is based on No, this is how much you can put in based on age, based on your
Oh,
annual
okay,
compensation. So
okay,
at age 45, if you're making $150,000, your deduction limit's going to be $87,000. The closer you get to that retirement age of 62, the more you can put in.
okay.
And obviously, the higher your compensation, the higher the amount is that you're going to be able to put in. Which, if you have that spreadsheet or that PDF with that max contributions, it actually shows higher earners and how it works out as you get to age 60, where you can actually put in 330 or $430,000.
Okay, take a look for that one there. Yeah, let's see. Okay. And then ultimately, from the tax return side, this $87,000, that's going to be a deduction for the company, correct?
Correct. Yes.
And that $87,000 doesn't have to be paid until that tax return is filed. So it would either be, say, March 15th, or if it's extended, it would go through September 15th.
That's correct. Yes. Great question. So, just like any retirement plan, you have until your tax deadline to make your contribution. So the only difference with defined benefit plans is that even if you're a regular corporation and your tax deadline's April 15th, your extension normally gets you out till October 15th. But with defined benefit plans, that final contribution has to be made by September 15th of um of the year following the plan that we're working in. So for example, if you're going to make um a $300,000 contribution for 2024, that has to be done by September 15th of 2025.
Yeah, so it's always a nice
Even
cash flow. You
Yes,
can actually push this out there. So I've kind of found the other thing here. So if someone has compensation of $250,000, they're age 50, they could potentially put away $245,000 as a company expense into the retirement plan.
correct. Correct. And this is just for defined benefit plans. So if you have a client or an employer that wants to do this large contribution, but they're age 50 and making 250,000, you can also include a 401k plan with a defined benefit plan, knowing that they can still do their max salary deferral limit. So at age 50, now they can do what, up to 30,500. And then they would also be able to do 6% of their compensation as a profit sharing contribution. So you're really doing $245,000 into the defined benefit plan. And then you're also going to do, I'm going to do the math real quick.
Sure.
Also going to do $15,000 as a profit sharing, and then we say 30,500 as salary deferrals. So would be able to put an additional $45,500 into a 401k profit sharing plan to get your total up to 200 and 280 90,000, 290,000 total
Yeah.
in deduction limits.
So depending if the cash, again, it all comes back to a little bit to cash flow potential too, but you basically are kind of basically going to be taking away all your tax liability for both federal and California.
Yes. Yeah, that's the nice thing. And you're putting it into an appreciating value as opposed to buying heavy equipment that may have a depreciating value or something similar. When
Yeah, and plus, if someone is willing to kind of help out their employees, it really becomes kind of a really great retention process for the employees too.
Yes, I agree with that 100%. So, and again, your employees are not going to be accruing this max 3.3, but they may be accruing 5% of their compensation every year or 3% of their compensation. We could write the formula so that your employees are receiving a benefit through the defined benefit plan. They would still be able to participate in your 401k profit sharing plan, but
Yeah.
this just gives them it's a good retention. It gives them a little bit more of an incentive to stay, and it helps them save for their retirement as well. When we're looking at formulas and we're talking about putting money into a defined benefit plan, the goal is to have somewhere between 85 to 99% of the defined benefit contribution go to the owners. Obviously, if it's an owner-only plan, then 100% of that would go to the owners.
Yeah.
But when you start including employees, the goal is to get above 85% going to the owners, and then the rest of the funds would be allocated to your participants as needed.
Okay, so you can structure that formula to be both the owner of the company, but maybe also key employees,
Yes.
and then
Yes.
try to dance around whether someone's, some companies have do annual bonuses that can be quite large. trying to begin that dance between what the bonus is going to be versus what the retirement contribution would be, and then working with the employees to understand that the bonuses are, what, 50% tax cut right away just on the bonus alone.
Right. Right. In this, if you're as an employer, if you're looking at paying bonuses and large bonuses, you have to pay workman's comp and payroll taxes and all kinds of things on those bonuses. Whereas if you were to make a contribution to a defined benefit plan and in conjunction with your 401(k) plan, you're negating those costs as an employer for yourself as well.
Yeah, yeah. I've had some clients have kind of gone through from the employee side and kind of sketched out like this. You start putting away to your retirement. This is what you're going to get in 10 years to help the employees visualize why these retirement plans are actually to their benefit. Because I think people really kind of like getting that cash. So this becomes a bit of an educational process for the employer to help the employees buy into the concepts too.
Yes. Yeah. And I understand that as an employee, right? Understanding having cash in your pocket.
Yep.
And at the same time, we look at current stats of those that are getting ready to retire and some nationwide stats of those that are, in that boomer era where we have, the 1960 babies that are getting ready to retire now or soon, and the average person at that age getting ready to retire has less than $50,000 in their retirement account. It seems to me like they're probably going to be working for a very long time. So retirement's kind of out of reach right now. So
Yeah.
having these plans, these defined benefit plans, these 401(k) profit sharing plans where the employer is willing to put some funds in for the employees really does help at the longevity of the employee being able to retire hopefully timely and not working until,
There's,
age 90.
yeah. Agreed. Yeah.
So yes. So, okay. So, did you have any other questions regarding the compensation versus deduction limit?
I don't think so. Yeah, that just is again, I was trying to encourage business owners to kind of have more profitable companies because it allows them to kind of have an end result that's more advantageous to them personally than often buying the piece of equipment or doing other things. Like this really kind of creates more value for them personally.
Yes. This here is just a good visual of the defined benefit accumulation. And it goes back to what I was discussing, like year one, you haven't accrued everything that you've put in, but by year 10, you've accrued up to 3.3. As long as your annual contribution's about $260,000, and you're going to say, okay, but over 10 years, $260,000 is not 3.3 million. Well, that's correct. We also write into the formula, we expect your funds to have about 5% earnings. So we're also looking at stock market growth. Um, and if it stays on a projected 5% earnings every year and you put in $260,000, this is what it could look like by the time you get to that 10-year mark at 3.3.
Yeah, if you throw in the IRAs, what the 401(k) is, that's actually gonna be even higher number over that time period too.
Yes, I've had clients do this, know that they're 52, they're going to retire at 62, they get to the 3.3, and because they also have that 401(k) function, some of my clients have retired with $5 or $6 million available to them.
Yeah, yeah,
So, um, okay, minimum and maximum contributions. So when you work with associated pension consultants, we provide a minimum of what needs to go in the plan. We provide a maximum contribution based on your compensation and what your max deduction can be for the plan. And then we give you a recommended contribution that keeps the plan within balance to get us to that $3.3 million or whatever the formula is set at that you're going to accrue by the end of the lifetime of the plan. So your recommended contribution is going to keep benefits and assets in line and it maintains the predictability. Just know that if you're doing minimum contributions over the course of the 10 years, then when you reach the end of the lifetime of the plan, you will have to do balloon payments or balloon contributions, if you will, to get to where the plan should be. So if I'm working on your defined benefit plan and I notice, Mr. Client, you've put in the minimum contribution the last 2 or 3 years, maybe we need to look at redoing your formula so that your current minimum contribution that you've been making is now within your recommended range so that when we get to the end of the plan 10 years later, you're not having to make large contributions to meet that goal that we had originally set up. Same thing with maximum contributions. If I give you a maximum contribution, let's say your recommended contribution range is 150 to $200,000 and your max deduction limit is $350,000, If you put in a maximum every single year for 3 or 4 years, by the time we get to the end of the lifetime of the plan, the required minimum contribution may be essentially zero because you're pre-funding future years when you maximize your contribution.
Okay, so this would be a case if someone had a couple of years where their financial performance was quite outstanding, that would be the time they could really kind of make the maximum contribution to time out the profitability of the company.
Yes. And I encourage that if they're able to do that, especially when they set up the plan the first 2 or 3 years, they're able to do the maximum for the first couple of years. I encourage them to do so because that way, if there's something that happens in the market, if there's something that happens cash flow wise as we get towards the end of the lifetime of the plan, they've pre-funded. So they're not going to have to be as anxiety ridden, if you will, of having to make these large contributions, especially in a down year, should that happen.
Sure. Yeah.
We can go to the next slide. Okay. This is sustainable contributions versus front loading, which we just talked about a little bit, but sustainable contributions are going to be within that recommended range. Um, that's going to, absorb compensation changes. It's going to keep the plan well funded. It's going to basically make it stable in funding so that the client knows exactly what they're supposed to fund. You stay within that recommended range. And should everything happen correctly, where we're having 5% growth and you've funded within the recommended range, then every year you'll know exactly what your contribution should be, regardless if your compensation changes slightly here or there. Again, if you decide to front load, you're pre-funding the plan, which means that if there is something that happens towards the end of the plan's lifetime for bad years, um, your required contribution will be lower. And it's a good strategy for those that have a lot of cash flow right now. You came into something, let's say you're an attorney's office and you're able to put $500,000 into the plan. Well, you most likely can do that as long as you have the compensation and the age to do so. Put $500,000 in, even though the recommended range is 200,000. Well, now you've pre-funded about $300,000 for future years. Um, which can be helpful should there be something that happens in the future. So, there are some disadvantages to that. We don't want to exceed the benefits that are distributable. So, like, again, if you're going to put in the maximum available to you every single year, as we get towards that 5 and 10 year limit, we want to make sure that you're not exceeding that 415 limit of that $3.3 million. So if you're working with a good TPA, they're going to keep you up to date on those things. Hey, we're reaching the 415 limit, or we're coming into certain situations where we may need to look at changing the formula. But if you have a good TPA that communicates those things with you, it shouldn't be anything to worry about. So, okay, we can go to the next slide. So these are just the next few slides are going to get into some funding scenarios. Um, and they're just a few different spreadsheets. We can just kind of leave this up for anybody that wants to take a look at it. But if we're looking at this first one where we have consistent rates of return, year one, the rate of return five.
I'd like to go back.
That's okay. That's okay. All right. So if we're looking at the first scenario here where we have consistent rates of return, and you're looking at a 10-year plan where your annual payment is about $222,000, then you're looking at about $2.8 million. This is a good visual of how you get to that 2.8 was the limit a few years back. So again, if we're looking at 3.3, then you would increase those payments slightly and you would back into it. So 2.8 was the maximum a few years ago. But again, if we look at consistent 5%, this is what your payment would look like. If we look at a loss in year six and plan increased contributions, so now we're looking at, we have a 30% loss in year six. So following year six, now you have an increased payment, right? 317,000 to get you back up to that 2.8. Um, Same thing if we're looking at, I kind of skipped around. But I apologize. So if we look at consistent rate number two, Where you front load, you do $320,000 and then you only do 35,000 for 1 year. Now you're back to that 222,000. But you can see how those first 2 years really funded, and then year three, the minimum that they had to put in was 35. So that worked out well for that client because maybe they had cash flow issues, or maybe they were waiting for cases to close that didn't close by the end of the year. These things happen. So by front loading it, now your required minimum year three is a lot less, your liability is a lot less. And then year four, everything picked back up and was right where it needs to be. And we still want to get to that 2.8 million. So we're going to continue to put in the larger contribution at 222,000. Um, if we have a scenario like in scenario four, where we have a market gain in year eight, that's significantly higher than the 5%, then you'll notice that years 9 and 10, there's no required contribution due because the gains in itself are going to get to that 2.8 years 9 and 10.
Okay. Yeah, this is pretty handy to see how the market rate, performance of the actual
Yeah.
investments can
Yeah,
affect.
yeah, and I'm glad that we're doing this because I think sometimes when you're explaining it without visuals, like people just can't see how that happens. But when you have these visuals, these funding scenarios, um, and talking about it like it's a mortgage or something similar, it simplifies it for people that most people have mortgage and or rent. Most people can take a look at this and be like, "Oh, okay, there's some compound earnings here. We're looking at 5% compound on an annual basis. This makes a lot more sense than just saying, well, we're working on a formula that's based on your age, how long you have until retirement, and what are we trying to get to? Uh, Now we're going to work backwards, but being able to provide these visuals, now you can kind of see exactly what it is without having to be like, well, it's going to depend on your age and your compensation, etc.
Agreed. Yeah.
Okay, cash balance plans. Cash balance plans. So defined benefit plans that we just discussed, most of those defined benefit plans, we're going to talk about having one or two employees or maybe no employees at all. You start having more than one or two employees, then we're definitely going to look at a cash balance plan. And a cash balance plan is a defined benefit plan that communicates its benefits in terms of a theoretical account balance rather than a final benefit. So what's going into the plan is what they're accruing as your employees. And this design is preferred for businesses with multiple partners and multiple employees. So if you have more than one owner, where you have, three or four owners or partners and maybe some key employees, that way they're able to define exactly how much they want to put into the plan each year, and then you give what's needed to your employees to pass, and you're working towards a benefit as opposed to or a theoretical account balance as opposed to a final benefit.
Okay, that is a little bit different concept there, isn't it?
It is. It's slightly different. Very similar, but slightly different. And it's basically a cash balance plan has a little bit more predictability with cost for the owners versus your employees. Like I can say I have an employer that has three partners, and one of those partners is the CFO. We have the president, the CFO, and maybe a secretary as the officers, if you will. And they know that the president and the CFO, they want to be able to give those guys $75,000 each in a cash balance plan. Maybe that secretary is going to get a $25,000 cash balance contribution, and then our employees, we're going to give them 5 to 7% of their compensation. And you can do that in a cash balance plan because you're theoretically working on an account balance as opposed to a final benefit.
Okay.
We can go to the next slide. This is what a defined benefit statement would look like if we're looking at a cash balance plan versus a defined benefit plan communication. So if you work with a TPA firm such as Associated Pension Consultants, we would provide a employee certificate, if you will. But what you'll notice is there's slight differences, right? So we have an estimated monthly benefit, and an accrued benefit. This exactly is what I was talking about, where the present value of the accrued benefit is 193,566, but maybe they've only accrued 1,800 of that so far because you're working towards the full benefit here of 193,566. And then over here on the cash balance side, you theoretically have this 193 as your ending balance, and the contributions that are going to be put into the plan for you will get there over time.
Okay. So you still kind of get the same point, just call something different ultimately.
Yes, ultimately it is. And with the cash balance plan, again, it's easier for those that have multiple employees and multiple partners because then you can define how much you want to put into for each person. And now you're working towards a balance as opposed to what your payout's going to be.
Okay. And then as that changes by certain people now become a key employees, I mean, you can redo the benefit formula so those new key employees now get to benefit more within the cash balance setup process.
Yes, yes. And cash balances are nice because they can run for a lot longer than your defined benefit plan. You're not looking at a 5 or 10 or 15 year term. You're looking at, um, obviously those participants have to be in the plan for 5, 10, or 15 years to get to that ending balance. But you can rewrite the formula. So let's say our president retires because in the cash balance plan, he's met his theoretical balance. He's ready to retire. Well, now we have a new president that comes in or something similar where you have new key employees, you can rewrite the formula so that the new key employees receive a similar benefit or whatever is decided on um, by the trustees or the plan sponsor, etc.
Okay.
Okay. So this just kind of gives you again plan design differences, and you can just take a look at it to see, the advantages and disadvantages. So which is better? Well, the advantages of a cash balance plan is that the communication needs and the benefit is more predictable. Um, Cash balances do have a higher administration cost because we're using actuaries. We have actuaries for our defined benefit plans, but the cash balance plans, you're looking at the actuaries and they're looking at more participants and more key employees and partners. So the formulas and the math predictions that they run are going to be more abundant, which is going to cause for a higher administration cost. Um, Again, an advantage is you get to use the cash balance plan for multiple partners benefits and use current compensation, but you're going to have lower maximum contribution limits compared to a defined benefit plan that just has your owner only employee. Um, you'll have some cost control over a cash balance plan. Like I've discussed, you can define those 50,000, 75,000, $25,000 benefits to certain employees. Um, but then you have less vesting flexibility like you would if you're in your defined benefit plan or a 401(k) plan because you are accruing a balance.
Okay. Yeah, that makes sense. It's not
Mhm.
necessarily going to be actually your term, but there's more of a balance to be dealt with then.
Right. I think what's the next slide? I think the next part of the um so there's some case studies that are at the end of this PDF, and the case studies are what it would look like if you have a new comparability 401(k) plan versus a standalone DB plan, or if we're going to do a tiered DB plan. So if you want to take a look at some of these scenarios, I'm more than happy to kind of go through them. Otherwise, we can take questions or
Sure. Yeah, I think we can probably just do some questions. I'll leave that open there. I don't know if we have any questions coming in from anyone quite yet, or anyone have any questions or different scenarios they're kind of maybe strategizing about how to maybe begin offering a cash balance plan or what that would really look like within their particular organization.
yeah. So if someone's looking to start a defined benefit plan or a cash balance plan, we would definitely want to there's certain things that I would need to be able to run a formula. So how long has your business been open? What's your compensation for the past 3 or 4 years? How many employees do you have, if any? And how old are your employees? How old are you as the employer? And their compensation amounts as well. And from there, I would be able to take those items and run a scenario. I would also ask, what's your comfortability level on, do you want to put $200,000 in? Are you looking to put more than that in? And from there, we would come up with a formula. Again, if you're making 260 to $280,000 and that $3.3 million looks good to you and it's just you as an owner only, then you would want to be comfortable putting in that $250,000 per year for 10 years. Let's say you're age 52, and that'll get you to retirement. Um, so there's a few scenarios that we run through. Most importantly, we're going to come up with a formula that the employer is comfortable with, um, as far as putting money into the plan and making sure that it's going to meet their deduction liabilities as well.
I just flipped this slide to be if someone's doing a defined benefit combination with the 401k salary deferral and the safe harbor profit sharing, what that actually looks like for people.
Yeah, perfect. And this would be for a 1 year run. So you're looking at, your two owners here are making 280,000. Employees 1 through 5 down there, that's their annual compensation for the year. The salary deferral limits change. So obviously they didn't max out here, but you could max out your salary deferral. Your 3% safe harbor is going to be based on compensation. You have to give 3% safe harbor to your employees. And then usually what we do is we give your employees a profit sharing contribution. To kind of offset how much the employer is receiving in the defined benefit value. They used to call these like carve out plans or floor offset plans where you could do all profit sharing and not have to give a defined benefit contribution to your employees. But those floor offsets are no longer available. So we still give a profit sharing here, and then we give a defined benefit value as well. But you can see here that the total defined benefit value is $376,000. And out of that $376,000, 340,000 of it is going to the two owners.
Okay. Yeah. Then ultimately the whole company ends up with a retirement asset, if you will, of over $6 million after 10 years.
Yes.
Yeah.
Yep. Yeah, and you can see owner one got to that 3.3, which is perfect, and that's what we like to see if you're able to do it. If if they're looking at trying to do a $2 million uh benefit at the time of retirement, then obviously the amount that you have to put into the plan would go down. But it is possible. So defined benefits are a nice way to earn or accumulate a great amount of wealth within your retirement account in a short period of time based on how much you can, what your cash flow is and how much you can put in the plan. And in addition to that, it helps with your tax deductions as
It
well.
does. Yeah, it really does help with the tax liability
hmm
quite significantly.
I have a client that is actually just turned 62 is turning 62 this year. Started his defined benefit plan at age 52, had two employees. His employees are getting a nice chunk of change ran the plan for 10 years. He hit that 3.3 maximum for himself, and his employees are probably getting about 400 or $500,000 a piece, which is he was happy with he was able to give them something, which is nice, especially when you work with the same two individuals for over the course of 10 years, right? And
Mm-hmm.
then along with his 401k plan, by the time he retired over the course of 10 years, he had about $5.7 million in total, which was good for him because he said he has 4 kids and he wants to be able to leave at least $1 million to each kid. And I was like, okay, sir.
Yeah, that worked out really well.
Congratulations. He hit his max. He was going to work for a few more years. And when he hit his max and he couldn't do the defined benefit plan anymore, he said, it's time to retire. And I said, okay.
That's perfect.
So, yeah, so it does work. It does work really well. But Evelyn, if you have anybody that has any questions or would like me to run certain scenarios, I'm more than happy to do so and more than happy to work with them on getting something set up so that they can make those large contributions. The nice thing about Secure Act 2.0 that happened is a few years ago, we changed the law or Congress changed the law where plans don't need to be set up by the end of the year anymore. So if you have somebody that's looking to set up a defined benefit plan for 2024, we have until the tax deadline to make the plan function.
Okay.
Um, I just asked that if somebody's looking for a plan for 2024 that we set it up, around July or August. So come September 15th, we're not scrambling trying to set something up and get a deposit in.
Yep.
But, we do have some time so that your clients and advisors and any of your other colleagues, can make a sound decision and have something set up for 2024, even though we are in 2025.
Yeah, so I'll keep your contact information so people interested who kind of connect you back up with them again and see how they can move forward, kind of adding on to more retirement features.
Yes. Thank you so much. Yeah. Do you have any other questions for me?
I don't think so. I think that was it
Okay.
for now. I know we always, once we get the actual formula, it's always kind of fun to kind of look through and see what that range of contribution is going to be too.
Yes. Yeah, I agree with that. And again, for anyone that thinks that the range is too high or a lot of times people will ask me to do a projection based on maximum, and then they'll get the maximum back and they'll see that we're at that 322 or $400,000. And if it's a smaller company, that might be overwhelming for some clients.
Yeah.
So I always just remind everybody that we can adjust the formula to what they're comfortable with. If they're comfortable with putting 100 or $150,000 in, we can adjust that formula so that's what it is. You're just not going to get to that 3.3 over the course of 10 years, right?
Yep. Yeah.
Maybe we need to run the plan for 15 years or something similar.
Yeah. So there's some flexibility there. It doesn't have to be just the 3.3 million that someone's aspiring towards.
Right. Yeah.
Okay. All right. Well, again, thanks for your awesome presentation, and we'll continue trying to work through people helping their businesses become more profitable so they can participate in these type of retirement scenarios.
All right. Sounds good. Thank you for having me. I appreciate your guys' time and have a good rest of the week and a great weekend.
You too.
Thank you so much.
Okay. Bye.
Bye.